Hello, everyone. Welcome back to Finance Friday on the ARCUK YouTube network. Today, September 16th, is my mother's 100th birthday. Now, unfortunately, Mom passed away just a few years ago at age 97, but I was so lucky to have her, so happy birthday, Mom. That's to you. Anyway, I'm broadcasting as usual from my home in Jackson Hole, where the tourists are now vanishing and the bears are foraging and the temperatures are dropping and the leaves are finally starting to turn yellow and red, all right on Mother Nature's schedule. It's perfect time of the year to be here. And so if you ever have a chance to visit this part of Wyoming during this time of year, bring your sweater, and I think you're likely not to be disappointed. Now, before I get into today's discussion, I want to have a word on terminology that I'm going to use today. As you know, I think it's incorrect and misleading to refer to consumer price increases as, quote, inflation, because in my view, inflation is an excessive increase in the money supply caused by government, and increasing consumer prices are just one outcome or one effect of inflation. But today, with the understanding that you know where I stand, I'm going to use the term CPI inflation, which most economists would say is actual inflation. Using inflation this way is, I think, conceptually wrong, but it's just more convenient and time efficient because that's the term everybody else uses. So when I use that term today, CPI inflation, please don't think I've sold out or that I'm sleeping with the enemy or something like that. Okay, now in preview, here's the game plan for today. I want to start by highlighting the big plunge in the stock market that we had this week. And I think this plunge marks a change in the way most investors view the importance of these high CPI inflation numbers we're seeing. I think investors are changing their estimates of future CPI inflation, and that this also changes their estimates of how aggressive the Fed is going to be in raising short-term interest rates. So we are going to talk today about how the Fed thinks about inflation and why they think the way they do, and how the Fed thinks will dictate what the Fed is going to do about it. So, with talking about consumer expectations and investor expectations and the Fed's thinking, I'll finally try to explain what exactly the Fed is going to do and what will be some of the important outcomes in the investment markets as a result of their actions. So that's going to be our roadmap for today. So with that, let me cue up my slides. Here we go. All right. Here's a chart that you're used to seeing, and we'll look at it again. Here's what happened this week. On Tuesday, September 13th, the Bureau of Labor Statistics, the BLS, reported the CPI increase for August. The CPI index increased 8.3% from August 2021 to August 2022. And that 8.3% was 0.2% higher than the Wall Street consensus of 8.1, which was also down from 8.5 in July. So the Wall Street consensus was that the CPI numbers were headed down sharply. And along with that was their hope that the Federal Reserve would not feel the need to raise interest rates so much that they would guarantee a recession. But on this disappointing CPI news, the Dow Jones Industrial Average crashed 4% in one day, and the NASDAQ and the S&P 500 did even worse. And that was the biggest one-day downward move in the market since the initiation of the lockdowns back in the start of the pandemic, back in March of 2020. And I can tell you, listening to the talking heads on Bloomberg, it this last Tuesday. It felt like pure panic. So where exactly was the inflation in that CPI composite number? Consumer prices overall rose only 0.1% in August. That was after being flat in July. But the overall August 2021 to 2022 year-on-year decline was almost entirely the result of falling energy prices. Gasoline fell 10.6%. Fuel oil fell almost 6%. And although that was a welcome decline from previous months when gasoline prices were, $5 a gallon nationwide, but these reduced energy prices were not enough to offset the higher prices in almost everything else. So the 12-month inflation rate was 8.3%, down from 8.5, but still higher than the 8.1 that was expected, and therefore disappointing. Food prices were the biggest problem for consumers. Grocery prices rose 0.7% in August alone, and they were up 13.5% from a year ago. And retailers are generally reporting that they see even higher prices ahead. The so-called core CPI prices, which is consumer prices excluding food and energy, also were up 0.6% in August alone, or about 6.3% year over year. So consumer inflation continues to run through the sectors of spending that are not directly affected by commodity prices in the same way that gasoline is directly affected by the crude oil price. For example, the prices of services like healthcare are continuing to rise. And so the CPI services excluding energy are now 6.1% more expensive than they were a year ago. Owner's equivalent rent, which is the CPI report's proxy for shelter, continues to rise at 6.2% year over year, 0.7% in just 1 month. So the overall CPI inflation number, despite all this, was still lower than last month, and it only missed expectations by 0.2%. So this raises a question: why would the market react so strongly to what looks like just a rounding error in the CPI? It's usually hard to tell, what news is financial news is motivating market moves, but in this case, the reason seemed very clear. 8.3% signaled to market participants that CPI inflation is not moderating as fast as expected, and even more important, the so-called core prices and core services, those that are less volatile than energy and food, seem to keep moving up persistently. They're not receding, and this is signaling that the Federal Reserve is going to be forced to maintain and perhaps even intensify its tight money policies. Tight money policies mean that the Fed is going to raise short-term interest rates higher than previously expected, and may hold them higher for longer than expected. And it also means less money sloshing around the economic system, to buy stocks and bonds. So it seems clear to me that the market was surprised by the inflation number, and it reacted with a big sell-off in both the stock and bond markets. The dominant view on Wall Street and among most economists is, or at least until Tuesday, that view was that high CPI inflation is just temporary, and that it's going to return to the Fed's target of 2% within a couple of years, that magic 2%. Now, I've showed you charts like this before, but I think they're worth looking at again. The data in this chart results from a monthly poll of about 70 Wall Street economists. The results of their answers are averaged and presented here by Bianco Research, and I think this is really great, unique work, so kudos to Jim Bianco and his group. Anyway, the dark black line there is the reported CPI inflation number as we go through time, and the stringy colored lines are the consensus prediction of CPI by these economists from that point on. So what this chart shows is that month after month, no matter how hot the CPI comes in, or how surprised the economists are by the actual results, they go right back to their old bias. So, for example, look at September. Down here at September. If I can find my mouse, look down here at September 2020. They think that the CPI is going to revert right back from less than 1%, right back up to 2%, just as the Fed predicts. Now, when inflation goes above that target, up here, say, let's go March 2022, inflation comes in at 6+%, they think it's going to revert right back down to 2% within a couple of years. So no matter how high CPI inflation goes, these economists always think inflation right now is always the highest it's going to be, and that inflation is going to trend right back to the Fed's promised 2% number within a year or two. They nearly all think this way, and they don't seem to change their minds. Look how persistent this pattern is month after month. I mean, this is true groupthink. Now, lest you think that it's only Wall Street economists that want to be stubbornly wrong this way month after month, here's a composite poll of non-US economists forecasting inflation in the non-US countries. I mean, this is not the same chart I just showed you, but the pattern is the same. And I guess all these economists just, I guess they all went to the same school or something. They clearly thought that the central banks have CPI inflation under control. And why did they think this? Why did they think this? Well, it's at least partly because the Fed did seem to have CPI under control from 2010 to up to 2019. And to show you that, let's just go back and look at the CPI number and look along here from 2009 or so to 2010. CPI inflation stayed way low here, right around 2% or lower. But this was a time when the Fed was pumping money at the economy at a very rapid rate. This was the time of quantitative easing, and it did not result at high CPI inflation. And I explained why in a previous talk that we did, and you can refer back to that if you want details. But apparently, all these economists don't see any connection between the rapid supply of money and an increase in consumer prices. They do, however, after years of price increases, now widely acknowledge the effect of quantitative easing on asset prices like stocks and bonds and real estate. But they seem to think that these rising consumer prices are due just to supply chain problems from the pandemic and things like energy shortages from the Russian invasion of Ukraine and so forth. So to many of these guys, CPI increases are just pandemic inflation or Putin's inflation. And therefore, they think that, just after only a few years, when the crisis dies down, we're all going to go back to 2019, to the pre-COVID economy, when consumer prices were rising at 2% a year, when it only took a few weeks to get a new electric bike from China, and so forth. Now it takes several months to get a bike from China, if you can get it at all. And the shipping rates have gone from $1,500 per ton per standard container unit back in the day up to $10,000 per ton, or I see, not per ton, per standard container unit. Now they've fallen back to say maybe 5,000. But these economists think that this is all temporary. Once the war is over and the supply chain problems are all ironed out, they think everything's going to get back to normal. But I think they're wrong about this, because since the pandemic, we have now very different demand patterns and different supply patterns than we had pre-pandemic. Different demand patterns result from things like more people working from home, less business travel, moving from the city to the suburbs, different patterns of air travel, booming tourist travel, that kind of thing. But different supply patterns result from the continued lockdowns in China that are hampering their economy, the disruption of food and fuel supply from Russia and the Ukraine. And so we have different supply, reduced supply, a different mix of goods and services demanded, and all of that complicates what was a highly specialized, just-in-time, well-functioning supply chain that no longer is set up for our demand and supply patterns. And so all this change in demand and supply is further complicated by an unprecedented wave of newly created money that was force-fed to individuals and corporations during this very badly mismanaged pandemic that we've been going through. So to put it simply, we have less stuff interrupted by logistics problems, being chased by record amounts of money. And all of this change disrupts normal economic calculation. It breeds business mistakes, delays, uncertainty, and as a result, higher costs. But most economists do not share my opinion that we have possibly have a permanently damaged or changed supply chain that you just can't fix by putting back to its previous state. It has to be readjusted and changed. And they also do not agree with me that there's a long-term problem of too much money in the system. And I think this is why they have seen CPI inflation as temporary. And if they're right, then CPI inflation probably will be temporary. But if I'm right, it will be embedded for a while in the economy. And I think this market decline we saw this week is a sign that they are starting to change their view on this. And I think that's what this week's terrible stock market action is telling us. Now, there's also other evidence that the market in general has been over-optimistic about inflation. Here's a pretty good representation of that miscalculation. This graph shows composite estimates of Wall Street economists for each month's inflation number. And as you can see by the long green lines in the bottom part, which are the difference between the expected number and the actual number. The expected is the orange line on top, and the actual is the blue line. They typically estimated a number that's significantly, a CPI number that's significantly lower than the number that's eventually reported. And this indicates to me a systematic kind of over-optimism. And as I just explained, this view, I think, results in part from their belief that the CPI inflation is driven by product shortages and supply chain problems that can be fixed quickly. And as I said, I doubt this. So this latest CPI print, I think, demonstrates that higher prices may be more persistent than many thought. And so the next question that we want to discuss and try to answer is, what is the Fed going to do about these persistently high inflation numbers? To understand what they are going to do, I want to start by going to the words of their boss, Chairman Powell, and get a quote from him. But before we do that, this might be a good time to pause for a question or a chat, because this is a good break point now that I think I've demonstrated that the market is changing its view on the severity of inflation. Daniel, do we have any questions or issues?
Yes, we have a couple of questions. So first, super chat from Free Trade. Thank you so much. Another one from Free Trade. He's asking, shouldn't price inflation result in lower business valuations, PE numbers?
Shouldn't price inflations result in lower business valuations? Yes. in general, it does. And that is something I think you are seeing in the market. As inflation goes up, interest rates should have to climb to compensate for inflation. This raises the discount rate for the future cash flows that are used for valuing a business. So in normal times, this hasn't always been true, but in normal times, you do see, as you suggest, an inverse relation, which shows that as inflation goes up, equity valuations go down. So yeah, good question.
We have another question. I wonder if for some reason inflation jumped 20 or 30%, would 32% the following year be considered on target inflation?
Yeah, so that's a good, yeah, I think, yeah, when you get to those kind of numbers, who knows? But I think it applies here. So yeah, I think this indicates what we saw here, if I'm getting the gist of your question right, to go from 8.5 to 8.3%, when 8.1% was expected, and to have that 0.2% difference in expectations cause such havoc, that is very weird when you just look at the numbers. So like I said, those could be rounding errors, right? But they did react to that. They were expecting, the market participants, stock and bond buyers and sellers, were expecting a benign number. They had their hopes pinned on a benign number. And so this was, it didn't take much. They were kind of on a knife edge, right? So it didn't take much of a change to have them just jump off the cliff. So to answer your question, I suspect when you get to numbers at 30%, a 1% difference in expectations doesn't mean so much. Under these particular circumstances, though, it meant a lot to market players. Hope I answered that question.
And then we have a super chat from Jeff Bannister. Thank you so much. And from Duane. Thank you so much also. And that's all the super chats.
Well, thank all of you very much for your comments and your attention very much. Okay, so anyway, this latest CPI print demonstrates to me that investors now think that these higher prices are going to be more persistent than they previously thought. And so now we need to look at what the Fed is going to do about it. And to get to that, what they're going to do about it, let's go right to the words of their leader, Fed Chair Powell. And here's what he said right here in Jackson Hole just a few weeks ago. Quote, "Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation." Okay, so the Fed will, quote, "forcefully depress demand to bring it into balance with supply." And Powell acknowledges that this forcefulness is going to cause some pain to households and businesses, which he says is unfortunate implication, a necessary evil. He says the Fed must continue to raise interest rates, keep them elevated, and bring the worst CPI inflation in decades back under control. That's what he's been saying for a long time, which the market has been reluctant to believe. So Powell's admitting that a tighter interest rate stance is going to be tough on workers and it's going to slow economic growth. However, he thinks that not acting will allow price increases to become a more permanent feature of the economy, and that would be even more painful down the road. And now, as I've said before, I think the Fed is committed to raising short-term interest rates to get CPI back to their famous 2% goal. And I want to explain why I think that remains their intention. To explain the the Fed's worldview, we have to understand a little about an economic device called the Phillips Curve. Now, the Phillips Curve was a 1958 invention by a mediocre economist named Phillips, a guy who we would probably not even know the name of if not for the unfortunate endurance of his famous curve. This particular slide here shows the title and the heading of his paper, which you can look up and easily find on the internet if you want to search and read it. Here is the device itself, the famous Phillips curve. Its major virtue is, I think, actually, it tells us how the Fed thinks, but not how the world works. Supposedly, this curve describes a real world trade-off between inflation and employment. Supposedly, Phillips's theory stated that increases in wages and prices, and that's along the vertical axis there, are related to the unemployment rate, that's on the horizontal axis, and that this relationship between the two is defined by a curve that's shaped like that inward sloping curve. A mathematical function. The lower the unemployment rate, the higher the annual growth rate of wages and prices. Okay? This curve will tell you, says Phillips, what the rate of inflation will be if you just know the unemployment rate. So conversely, the higher the unemployment rate, that's going to the right on the horizontal axis, the lower the rate of growth of wages and prices will be. So just stay on the curve and you'll know what each one will be. And note that this alleged trade-off is not a straight line, but it's this, you would call it, I guess you would call it mathematically, a horizontal asymptotic curve. Mathematicians can correct me if I have that wrong, but meaning there's kind of a sweet spot on the middle where the trade-off between unemployment and price inflation is optimal, and that's kind of represented by the corner of the two red lines there. So the idea is if price and wage increases are too high, let's say they're at 6% on the vertical axis, and unemployment is very low, the Fed can raise interest rates to dampen the economy, lower the demand for labor, lowering wage, that will lower wage increases, and that will push unemployment higher to the right. Notice that the lowering of wage increases is synonymous to them with lowering inflation, because price and wage rises and falls tend to go together. Now, this is a dubious theory at best. To me, it's the epitome of central economic planning or economic central planning. It was an outgrowth of the Keynesian economic thinking, and for decades, this theory actually had credibility among mainstream economists. But the inflation of the 1970s blew this theory to bits. During the 1974 and 75 period, overall prices and wages increased, while at the same time, the pace of economic activity declined and unemployment went up. Didn't follow the curve. Economists adopted a word for this so-called unexpected event. They called it stagflation, meaning low growth, high unemployment, and high inflation all occurring at the same time. Kind of what we may be expecting down the road. Now, likewise, in 1979, there was a large fall in economic activity with accompanying increases in the CPI. There was more stagflation. And by December 1979, the yearly growth rate of industrial production was 0, while the CPI grew at 13%. I mean, this is making this theory look ludicrous. Now, I'm not going to go into the full economic refutation of the Phillips curve because we don't have time, but still, if you're interested, I recommend you read George Reisman's rebuttal of the Phillips curve in his book, Capitalism. Just check the index under Phillips curve and you'll find it quickly. There's about 3 references. They're all brief and pithy. So anyway, the Phillips curve, I say, is just wrong, and everyone now knows it. See, everyone knows it. Still, this is how the Fed thinks things work. And I have to ask the question, why does the Fed believe in this paradigm, even though it's been discredited? And I'm going to take a little excursion here and psychologize. I think it's because it is what I call their bureaucratic imperative. So why, for example, does the entire bureaucracy of the Environmental Protection Agency believe that life-giving carbon dioxide is killing the world despite mountains of evidence that this is false? That's just false. The reason is because they're hired and paid by the government to think this, and their positions are validated by law, no matter how stupid that law is. So they have this, what I call a bureaucratic imperative to believe or act as if they believe in something that's not true. So here's what happened to the Fed. Even though the Phillips curve theory was not very credible, Congress passed this Humphrey Hawkins legislation in 1977 that legally validated the Phillips curve by giving the Fed a mandate to promote full employment and stable consumer prices, the 2 axes on this curve. The Fed was handed the challenge defined by this law of optimizing the alleged trade-off between unemployment and the CPI. And by law, the Fed can manipulate interest rates and money supply to influence the 2 axes, unemployment and inflation. So whether the Phillips curve analysis is correct or not, or whether the tools that the Fed uses are effective, the Fed has a bureaucratic imperative to fight the inflation battle as defined by law with the tools that Congress has provided by law. Never mind the collateral damage to the economy caused by imposing artificial interest rates and unproductive money creation. This theory and law confines the Fed's thinking. Now, the point of the excursion into the Phillips curve is to show how the Fed must look at the problem of inflation. They're required to see inflation as a rise in consumer prices that can be traded off against unemployment. They are obligated to manipulate these 2 economic variables, price inflation and unemployment. And to do this, they have 2 legal tools: control of short-term interest rates and the ability to influence the money supply. So they are practically commanded to believe in the phony Phillips curve paradigm. The only question is how aggressively they're going to employ their tools in response to the data they observe in this paradigm. Not only it's not what they do, what they're going to do. I think we know that, but it's how aggressively they're going to do it. And so this is, I believe, the Fed's paradigm, this Phillips curve paradigm, is, I believe, the Fed's starting point in their thinking patterns. And armed with this Phillips curve paradigm and their interest rate and monetary tools, they have vowed now to be aggressive in fighting CPI inflation. And frankly, I take them at their word. So now it appears that more and more investors are starting to believe the Fed's promise to raise rates aggressively for several more sessions. So this raises the question, how high will rates go? Now, this chart shows investors' predictions of short-term interest rates using interest rate futures contracts from the Chicago Mercantile Exchange. It's a report on what the commodities traders are doing with their money. And as you can see, their bets on higher interest rates have risen as the inflation data has come in. And these traders are obviously becoming more confident that the Fed means what it says. Now, on Wednesday, the day after the 4% crash, Ray Dalio, a very successful and influenced hedge fund manager, he runs a group called Bridgewater Associates. He wrote a very bearish piece on LinkedIn, predicting the Fed will have to raise short-term rates to at least 4.5% in order to kill demand enough to suppress CPI inflation. He wrote, quote, "It looks like interest rates will have to rise a lot toward the higher end of the 4.5% to 6% range. This will bring private sector credit growth down, which will bring private sector spending and hence the economy down with it." And then he added that a mere increase in rates to 4.5% would lead to a roughly 20% plunge in equity prices. Now, I thought this was significant because of Dalio's strong reputation and wide influence. I suspect his article marks a turning point in sentiment. And I guess I'm guessing that many more investors will now capitulate to the view that both interest rates and unemployment must rise in order to restore price stability. And of course, as Dalio points out, higher interest rates are bearish for corporate earnings, investments in productive enterprises, they're bearish for bond prices, stock prices, mortgage rates, house prices, you name it. And to give you an idea of what rising interest rates have already done to bonds around the world, here's an update on the total return year to date of the Bloomberg Worldwide Aggregate Bond Index. You've seen this chart before, and note the blue line at the bottom, that's this year. Note that the losses year to date have eclipsed any record by far that we've ever seen before. And that things have deteriorated further since we last bottomed in June. Now, we've never seen a bond market perform this poorly before in the 30, 40 some years of this index. I mean, nowhere near this badly. So barring a miracle this year, by the end of this calendar year, we're going to see the worst bond returns in history. And all this is from, so far, just a couple hundred basis points increase in bond yields instigated by the Fed and duly copied by other central banks except Japan. And I mean, this is the mirror image of what happens to bonds when you get falling interest rates. If the Fed raises short-term interest rates further from the current 2.5% to 4.5% to 6%, these losses are likely going to worsen. And the effects on everything from portfolio valuations to investment decisions could be pretty profound. But so far, I mean, this is carnage. But so far, this carnage has not deterred the Fed from its aggressive program. The stock market does not look much better. Here's a screenshot of the S&P 500 index that I took just this morning. The market's down about 20% from its January peak. If Ray Dalio's right about a further 20% drop in the market, we're going to be down to levels where around midway that we were around back here, down about midway through 2019. And even that, though, would not be historically cheap based on a lot of indicators. So I'm not going to be surprised to see even lower levels before the stock market bottoms out. So I agree with Dalio. My expectation is that inflation is going to be persistent. Therefore, the Fed will continue to tighten aggressively. And as a result, high interest rates and slower money supply growth are going to put a big damper on stock prices. Now, that is my logic. But my logic depends on whether this CPI inflation will really persist for some years, because that's going to dictate what the Fed will do. So therefore, I think I need to explain why I think CPI inflation will persist. Okay, why do I think CPI inflation will persist? Well, first, just to recap, I do agree with some economists I read who say that the changes in demand and supply patterns are radically different now due to government's, pandemic policies. To just recap, the work from home trend all by itself is a game changer. It's causing change in demand patterns. And then you have the deglobalization production due to international conflicts that we have with China and with Russia. And then you have the energy shortages. This is very critical, that are caused by green energy policies all over the world. Other than the aggressive nature of China and Russia, which is causing problems, these supply issue problems we have are basically self-inflicted wounds, by the U.S. and other Western nations. These physical supply and demand problems and issues are big factors in keeping costs high and preventing production from catching up with the higher demand that has been instigated by excessive money creation. So I agree with many economists that supply and demand factors, physical supply and demand factors, are different now and will be for a long time, and that these factors are going to prolong the trend of higher consumer prices. But I think there's more to this story, this persistently high CPI story, than just supply constraints and these changing supply and demand patterns. The other essential part of the story is the unprecedented growth in the money supply. And here is that familiar chart from the Fed to remind us of how big the broad money supply growth was. Unlike some economists who downplay the role of money creation, I think there's a good chance that all the money printing the Fed has done since the pandemic, you can see a big tsunami wave there, all of that is going to have a powerful upward effect on the CPI that may last for years. And to justify that expectation, let's revisit a chart that created by Lynn Alden that I showed you back in June. Now, this chart requires some heavy lifting on your part, so let's concentrate for a minute. Now, you've seen it before. Each point on the blue line represents the cumulative percentage growth over the previous 5 years of the broad money supply, M2. And M2, recall, is basically bank deposits plus currency in circulation. It's the money we buy things with. So, for example, look to the middle of the chart at the tall blue peak. This says that in about the year 1946, over the previous 5 years, M2 had grown by a little over 90%. And then about 2 to 3 years later, according to the orange line, M2, the cumulative 5-year CPI growth was about 30%. They averaged that 30 over 5 years, and that's an average of about 6% per year increase over that 5-year period. Okay, now look to the right of that tall peak to the next fatter but lower blue line at about the year 1977. In 1977, the cumulative growth in M2 per capita was a little over 50%. 3 years later, in 1980, according to the orange line, the cumulative 5-year growth in the CPI was a little less than 50%. That's an average CPI increase for those years of, say, 9%. It's a little hard to tell from this graph. I don't have the raw data, but that's what it looks like to me. Anyway, as you know, the late 1970s and into 1981 was the last big episode of persistently high CPI inflation. That is until today. So the pattern of this chart suggests that CPI increases follow money supply increases over time with a 2 to 3 year lag. All right, now let's look to the right and look to the future. Look to the far right at the chart and consider today. It's September 2022. And we've just started to experience the highest annual CPI growth since that big CPI inflation episode of the late 70s. That was 40 years ago. As of late September 2022, the 5-year accumulation of M2 is up about 60%. This is not all shown on this chart because it's not quite up to date. I calculated that 60% cumulative number based on up-to-date current M2 data from the Fed just yesterday. Now, if 2 or 3 years from now, the 5-year cumulative CPI is only up half of that 60% increase, say it's up by 30%, That would imply an average 6% annual CPI increase over that 5 years. That is the period 2021 to 2026. So with only about 1 year of these 8+% CPI inflation under our belt, there's good reason to think we still have a lot of embedded CPI inflation ahead of us due to this large cumulative increase in the broad money supply. At least this is what the history of this chart suggests to us. Now, admittedly, this is speculative and imprecise, this kind of estimate, but it does make Ray Dalio's upper end assessment of 6% Fed funds look entirely reasonable and maybe even too low, because historically it takes a Fed funds rate higher than the CPI to bring the CPI down. All right, now I hope I explained that clearly. This is not a prediction of inflation for advice purposes, but I am personally acting on this high CPI inflation scenario as my expectation in my personal financial planning and in my private affairs. And I'm working as if high CPI inflation is going to be with us for several years to come, even though it's quite possible it's already peaked. Now, the Fed, through Jay Powell, has said it will raise rates enough to kill CPI inflation. I believe Jay Powell, because I think the Fed is highly motivated to continue on this tight money policy, tight monetary course for several reasons. And I want to give you those reasons. First reason, controlling inflation is the Fed's assigned task under the Humphrey-Hawkins legislation of 1977. They are also tasked with maintaining full employment. But Powell sees the strong labor market, and he thinks he has room to work with employment before he ultimately kills jobs and the economy. So he can trade off many jobs to get CPI increases under control. So to repeat a previous argument, institutional duty or bureaucratic imperative is the Fed's motivation number one. Okay. Second, the Fed needs to regain its reputation and its credibility. They completely missed the current CPI inflation episode. They're embarrassed, and their jobs and even the existence of the Fed may be on the line if they don't stay the course now until CPI inflation goes way down. So credibility and job security is motivation number two. Now, third and finally, the stock market and other asset prices are now not as crucial to the Fed as they once were. Over the last 12 years, the Fed stepped up asset purchases and lowered interest rates every time the stock market went down. And the asset markets, meaning stocks and bonds, responded positively to this. Market players learned to buy the dip because they were saved by the Fed, and it worked. But during all those last 12 years, Powell did not have roaring CPI inflation to stand in his way. He learned, or so he thought he learned, that, and the market learned, they could just step on the monetary gas without causing CPI inflation. But ultimately, he was wrong, as the last preceding year now of high CPI inflation has shown us. So Powell knows that CPI inflation is political dynamite. High consumer inflation causes regime changes. You can see it all over the world. He does not dare not fight inflation. So he's now much less concerned about the level of prices in the asset markets than he used to be. He's now much more concerned with the guy wearing jeans on Main Street than he is with the guy wearing pinstripes on Wall Street. If he has to choose between the two, I believe he's going to decide to let Wall Street suffer. So political pressure to keep the pitchforks in the barn and away from the peasants, out of the hands of the peasants, is motivation number three. Okay. So how high will rates have to go? I don't profess to know with any certainty. That the paradox of Fed policy is that higher rates can dampen consumer demand, but also kill investment demand, including the need for hiring people. So by trying to lower the rate of consumer price increases, the Fed is also probably likely to damage the productive foundations of the economy. As von Mises said, it's like running over someone with your car and then trying to fix the problem by going into reverse and backing up over the dead body. Simple reversing course of easy money does not fix the problem that you created with that easy money. So, I mean, oddly, mainstream economists don't seem troubled with this contradiction. Now, I should add that there's no reason a free economy cannot have growing employment and stable prices or even declining prices. We've seen it before in more free economies. We should just let markets work. But that means letting interest rates find their natural level through competitive price discovery and stopping unproductive money creation. And it means patience and confidence in markets. In other words, it means policies that we are not going to see out of this Fed and this administration. Doing nothing, as we've seen, is just not an option for them. It's just not an option. So I don't know how high rates will go, but I suspect they're going to go high enough that something, some industry, some sector, or maybe several important companies are going to break and have a brush with bankruptcy. However, I don't think the Fed or any administration, whether it's a red administration or a blue administration, is going to let an important company go bankrupt and reorganize with more efficient capital and less debt, which would be the most healthy thing for the economy in the long run. But I don't think they're going to let that happen. That brings me to the last expectation I have that I want to share, and it's something I've mentioned before and will repeat. Over the last 2 to 3 years, the Fed's become much more aggressive and active in its money creation policies. As Jim Grant has remarked, radical monetary policy spawns even more radical monetary policy, and that's what we've seen at the Fed. Lev Menand's book, The Fed Unbound, which I reviewed several podcasts ago, documents this increasing Fed activism quite well. And I expect to see more of it, more targeted lending directed to specific firms that are in trouble, or more direct asset purchases of the debt or even of the equity of troubled firms by the Fed, just as we saw during the pandemic. The Fed might let some less important companies go bankrupt as the economy weakens, but the Fed and Treasury will never let American Airlines or a major tech company go down any more than they would have allowed a significant bank to go down during the great financial crisis. So to them, these big important companies are just too big to fail. And so I expect the Fed and the federal government will intervene directly in those kinds of companies if they get into trouble. And in anticipation of that, I'm calling this potential policy, quote, selective reflation. It's just logical to me that this is what the Fed will do and what they'll try next. Okay, now, for lack of time and space, I've not commented today on the Fed's announced policy of so-called quantitative tightening. Just had to concentrate on interest rates today. But that quantitative tightening, which mainly consists of letting some of their treasury and mortgage-backed securities holdings mature and run off the balance sheet, is just starting, and so we'll delay comment on that for another day. Okay, so I'm going to stop there today and take any questions that may be out there. Go ahead, Daniel.
We have a super chat from Kathleen. Thank you so much. She says, great charts and explanations. Many thanks.
Okay, well, thank you.
And that's all we have.
Okay, good. I'm happy about that. I'm not happy. There's no questions. But I prepared a bonus chart. So here it is. Let's just take the last three or 4 minutes to do it. So this comes from FactSet and Bloomberg and various analyses from Sanford Bernstein. What they did is they went back, and in the middle there is the time when peak consumer price inflation occurs. And then they tracked the average returns on the S&P 500 over the following year. So, or actually over the following weeks. So you can see that on average, when inflation peaks, that the market does pretty well. So if you think inflation has peaked, it peaked like what, 9.1 or 9.3% a few months ago, then that says that in the future, we might be looking at a pretty solid return, sort of counterintuitive. Okay, so but I wanted you to think about that and to consider if that's what this chart is really telling us. Because to look at the shaded area, that is the range of outcomes. What you see there on the dark blue line is only the average. The range of outcomes is quite large. I believe I said, by the way, I'm sorry, I believe I said on the horizontal axis that there was weeks. Those are days. That's this is measuring a 1 year holding period after the peak of inflation. So if inflation peaked in, say, July at 9.1%, and the market is going to go up to, get a 20% gain between where it was in July and July 2023, it's got a pretty big gain to go. So, but I thought this was interesting. This is average market performance. But notice that the variations around the average, as represented by the shaded boundary there, is quite huge. My bias is that it's slightly more, or maybe even worse. We have worse inflation than normal. We have a more aggressive Fed than normal as a result. And valuations were already higher than they've ever been and historically high by every standard. So we have every reason to think that, I think that performance going forward from peak inflation is not going to be quite this good, assuming, again, that peak inflation was 9.1% a couple of months ago. That's my opinion. You're certainly entitled to yours, and it's certainly as good as mine. But that's the bonus chart for today, and I thought it was kind of interesting. This is a really interesting piece of historical work. To me, the main thing it gives you is it highlights the uncertainty of the stock market while giving you a slightly counterintuitive record of what the average has been after inflation has peaked. Okay, now it is time to stop because Daniel's got a show to do and we're down to 2 minutes. So thanks, everybody. I will going to have to take a break next Friday. I have some writing to do. I have to catch up. So I won't be able to broadcast next weekend, but the weekend after that, or the Friday after that, I should be back. So thanks, everyone, and have a wonderful weekend, and you take care.